Hi, investors. It's Nick, and
Hi from Martin.
today we are going to talk about mortgage financing and the current state of the market and what deals actually work, and just have a look into the future a little bit, and just give you our general opinion about what's next. So, caveat before we get into it: I'm not a mortgage advisor. I'm not qualified to give you financial advice, and you should go and talk to your own financial advisor before, when, for context, I'm just telling you stuff that I see, and that if it were me, this is what I would do, kind of thing. But it's not advice for you. Go talk to your mortgage advisor. Now, with that in mind, I have been talking to David Eva, who is my favorite mortgage advisor, and he's been telling me that the market is still very quiet. So I'm going to share my screen, and I'm going to go to the respective websites for a few of the borrowers that I know about, and then we go from there. So the first one is, I'll go Together Finance. Right. So these people are open to foreign national buyers, apparently, and but they're charging 10% on their mortgages, which is just crazy, or 10% or thereabouts. Again, it's not financial advice. Talk to your mortgage broker, but that's what I understand to be the case. Together are not a bank that I hear about very often. So obviously, when we find properties for clients, I'm paying attention to who provides the mortgages, because that's how I can understand the market and help clients in one way or the other. Now, the main go-to lender is Gatehouse Bank, and they're saying no business, we're not open. And they've been in this kind of state for maybe 6 weeks to 2 months, I think it is. It's been a while now, and I would have thought that they would have just kind of got their admin sorted out. So the reason they closed and stopped taking new business was simply to clear the backlog of business. But we're 2 months down the road nearly, and you would think that they would clear a backlog, but apparently not. And of course, they've held off from going back into the market, I suppose, because of the mini budget, which happened a few weeks ago, which spooked the markets and spooked mortgage providers, and therefore Gatehouse had already suspended, but I suppose, speculating here, Gatehouse continued their suspension of services because they just want to see what happens with the markets. I think, as of speaking, this guy will probably take over, and assuming he does know about economics, so I think the markets will be happy to see him, and then hopefully we'll get some interest cost subsidence. So anyway, that's them. Now the next company would be these people, Octopus, and I see these people in the marketplace quite a lot. The backstory with these people is that they're not actually a bank; they're just a lender, and they specialize. This particular company specializes in lending for the residential buy-to-let market. They're happy with foreign nationals, as far as I understand. I know this because I've got a few clients who've used them for mortgages, and there haven't been any issues. Their circumstances aren't your circumstances. Talk to your mortgage advisor, etc. But anyway, I would say that they are one step away. Their mortgage, their buy-to-let product is one step away from bridging loan. And as I understand it, again, not financial advice, read the website, but typical offer is 2 years, a 2-year mortgage, and then you have to get lending elsewhere after that, or they can reorganize the finance. But the main point is that they'll go up to 70% LTV at £50,000 minimum loan, which makes the cheaper properties worth it. But they're not in the market right now because their rates are paused. So they're just saying, we're not available. Don't know when they'll come back. I suppose when it hurts them enough, when they think, you know what, we better just reopen so we can get some more business in. But that'll probably happen when the markets calm down a little bit. Then the final lender who is available is open for business, but as we'll see shortly, is not offering something that's viable. Then so there we are. So the issue here is that the minimum mortgage size is £100,000, and at that kind of level, you have to be getting at that interest rate, you have to be getting incredibly high yield at, say, minimum purchase amount of £140,000, and those yields aren't viable. And we're going to use that 7.99% number when we're looking at a few deals. So that's roughly where we're at. It's not very pretty. Overall, what I'm seeing, or we're seeing, Martin and I, is that it's just quiet. And we're in this kind of no-go zone where I'll stop screen share. We're in this no-go zone where there a lot of the cash buyers that we've got are kind of lurking at the moment, and they're not coming out of cover yet. And I would argue that's because there isn't a housing crisis yet. So markets move really slowly. And when they crash, I'll just share a screen with you. And I know Martin's on the schedule, so I'm not going to dwell upon this for long, but I'll just show you a couple of charts, and then that gives us context, and we talk about what's there today. So this is the previous crash, 2008, and it took 18 months for it to dip 15% in the northwest of England. So the best prime buy-to-let is in the northwest, especially around Greater Manchester. Doncaster's okay, Sheffield's okay, and Liverpool is okay too. But the point being, it takes a while for markets to shift. There's such a huge underlying demand for property because there's such a lack of supply that there is a market for property right now. So property prices are basically holding up. Properties that are so I'll talk about the future of interest rates in a minute, but what I'm seeing is that, and Martin will corroborate this, I hope, or maybe not, and if so, that's helpful too. So what I'm seeing, Martin, is lots of deals are collapsing, lots of properties are coming back in the market. But because of the way markets run very slowly, there's always a cushion of a couple of months before sellers get desperate. And the other point to always remember about a market is that a small representative sample drives the whole market price. So in other words, in an average area, 2 houses out of 100 will be sold each year. And those 2 houses basically set the market price for the other 98 houses. So if you have a huge depth of demand, and if those 2 houses get sold for a reasonable asking price, then the other 98 houses are deemed as holding their market value. So it's a very precarious situation. So anyway, what I'm saying is that the prices are basically holding up. But if the mortgage market continues going in seizure, in other words, what's happening is you've got the base interest rate, I think about 3% or 2.75% at the moment. And then you have this huge extra margin, which is the LIBOR rate. In other words, the price of money that banks borrow at. So what they do is they buy money and they sell money, and they sell it at a margin. And there are 2 parts to the margin. One is profit and the other is risk. Actually, it's the third part. So there's profit, there's the bank risk, how much risk they believe there is in lending the money out, and then there's the cost of money, and that goes up or down depending on how much risk the market believes there is. right now they believe there's a lot of risk. So interest rates are really high, even though the base interest rate is 2.75% or something. So it's a really big disconnect, and we've had this for a few weeks now. And the question is, will the arrival of a prime minister who actually knows about money, will that help? And I think it will. And my guess is that it'll, in another 3 weeks or so, markets will subside, that the cost of borrowing will reduce, and things will kind of get back to where they were. But on 6th of November, we have the Bank of England Monetary Committee meeting, and we don't know how much they're going to raise interest rates. So likely outcome for foreign nationals, we're probably looking at 6%, I would have thought. 6% interest rate, somewhere around there. So that's that, and I expect interest rates to hold for a couple of years, and then once inflation subsides, and remember that inflation is demand for goods and people being able to pay more to compete for goods, and the outcome the Bank of England wants is where people have to make do without because they don't have the money to bid up the price for stuff. In other words, fuel costs rise, people just drive less because they are broke. And that's how you reduce the amount of fuel being used or energy being used, or they use less heating fuel and everyone's colder. But the point is, whatever happens at the end of this, it's bad for people. Anyway, if you look back, I'm going to share screen one more time, and then we get into Martin's stuff. If you look back in World War II, low interest rates, this is inflation, the red line, and we had lots of inflation, lots of supply side inflation. Then after the war, the economy opened up. So think of World War II as COVID, and then think of now as after the war, after COVID. Huge spikes in inflation, 10%, similar to what we see today, but relatively low interest rates. And it was only until the 50s when the economy finally kind of regained its footing and everything settled down that interest rates rose, but they rose because they could afford to, because the economy was genuinely warming up for the right reason. There was supply and there was just a lot of activity in the market. Anyway, so the likelihood is I think it'll be something like this. You'll have big supply side inflation, a rise in interest rates, and then a decline in interest rates. And then finally, sometime around 2030, the economy will finally get together and things will move forward. But we have a double headwind, which is a triple headwind, actually. We've got Brexit, we got COVID, we got four things that are going against us. We got COVID, we got onshoring because of, say, a shift away from globalization. We've got Brexit, which is a huge hindrance economically. And then we've got artificial intelligence and technology, which will cause huge unemployment because it's more efficient not to hire people. So large areas in the north of England are going to get decimated, in my opinion. But those are the four headers. Anyway, in 10 years' time, it'll all be over and things will be on a new footing. The economy will reinvent and everything will be okay. And we'll go through another property boom. But we've got a long way to go before then. So the net result, as I see it, is it's all about the cash flow. Cash flow and safe properties where nice people want to live, who will look after your house that you own, that they rent, and those nice people keep their jobs because they're the ones that the society needs when things get really harsh. So there it is. That's that. Now, with all that in mind, Martin, would you be able to share your screen and show us a few properties, and we'll then talk about some numbers. Whilst you're talking about the property, maybe I'll do some numbers and we'll just work out what deals work in the current situation and maybe just do some tweaks on the interest rates.
This is one example, this property in Leith. Leith is a really nice location for investing because the property prices are not that expensive, but it's in the greater Manchester area. So this one example, this here location is good, it's close to amenities, so it will rent 650. So this one.
So how much? 100,000 for that at
Yeah,
650 a
but
month, yeah?
yeah, but if you buy in cash, I think 102, 104, something like this.
Okay, so I'll say 102,000.
Yeah.
And what's the rent on that?
Let's be like 625.
Okay, so that gives us a yield of just, and what sort of condition would that be in?
It needs like let's say 5,000. Just
Okay,
because the
so
electricity.
complete redecoration, that kind of thing.
But it's not really. But I'm just afraid for electricity for this one.
Okay,
If the electricity is good, you don't need to do it.
well, let's assume it will be good. So let's say £5,000 redecoration. So I'm going to share my screen. Is there, before I share screen, is there anything else you want to say about the property so I can just
No, it's really
share
nice
some
investing
numbers?
in my point of view.
Okay, well, I'll share my screen and just show you the numbers. And here we are. So the postcode is irrelevant. So I used to use this for capital gain numbers, but it's still quite helpful in that it demonstrates whether it's a strong area or not. Right. So our target yield, in this case, we'll say 7%. It just helps me do comparables. So that's 7% gross rentable without the renovation, 6.7. So is that, could you get higher yield than that, or is that about it?
Yeah, 650 it can be rented.
Okay, well, let's go 650, because actually the other big thing I'm seeing is that because this kind of property is now very difficult for owner occupiers. Sorry. We're seeing more availability of these, and we're seeing a big push on rents as well. So it's one of those weird things. And rents generally go up in line with inflation, and we know there's a lot of inflation around. All right, so 7.3, and if we assume, so let's just look at some numbers here. The minimum mortgage would be 70,000. So if you're buying a property with, say, these guys, Octopus, their minimum mortgage sum is 50. So that's good, £70,000, 50. So far, this might work. And let's say it's that's the pressure test. So their interest rates, we don't know what their interest rates will be, but I'm going to assume it's 6.5%, something like that. And therefore, sorry about skimming around like this. Right. So I'm going to say when they get back for business, 6.5%, and that's cash flow positive. So it means that you get an ROI of 1.6%, which isn't great. So a lot of this is about just minimizing your mortgage exposure on this. And therefore, if you...
But I will go with 60% loan to value for this cheap property. I will not go with 75.
Yes, and I agree with you. Sorry, I'm skimming around here. So we'll go 60. There you go. All right. So the minimum mortgage amount for this will be, mortgage amount will be 60. So that's good. So therefore your cash ROI on this property, so it's 50%. So the total cost of purchase would be £50,000 with all the fees and all the stuff. And therefore your cash ROI would be around, in year one, 2.33. But what happens is you get a lot of inflation. So high inflation, medium rates, fairly high rates. So you're talking about longer term, if you adjust for inflation, 3.2%. But if you go for just a cash purchase and you avoid financing altogether, let's say you do that, let's see what the ROI looks like. It should actually be higher, believe it or not, because the cost of interest is high. And it will be somewhere around 3.89%. So somewhere around that. Plus, if you factor in the capital gain, and there will be some capital gain on this property, but it'll be slow and you're going to have to wait for it. So once you start to look at all that, then the numbers get much higher. So capital gain is not 10%, but it might be, say, 5% or something. And when you start to look at that, your actual ROI starts to look in the region of, say, 8 to 10%, something like that, which is a reasonable purchase. So certainly in my case, what I feel about this is that these little cash properties, they're good. And if the price of money drops enough, then they're worth buying. Could you show us another property, Martin?
Yeah, but these properties will work more. How you go higher in the price range, the yield, it will not hit 7%. So
Yeah.
the issue is that, for example, I will show you 145. This is Doncaster. So it's very nice location, really central Doncaster. But the rent will be 750 for this one. So it's a nice, very nice property, but the yield is around 6.2. So it will look like a really nice house.
And you know, the benefit of a house like this is that you're probably more likely to get a better tenant, less hassle.
Yeah.
So the equation is very simple. You pay more, you get less hassle. That's roughly how it goes.
Yeah.
And of course, this is a nice house, very nice house actually.
Yeah. So for example, also this one in Dresden, this terrace house. Sorry, I just need to. I think. So the house is somewhere here. So there are terrace houses. This part of Dresden, like it's not the best part of Dresden, but it's still good. So and the price for this property is only 180. So and the conditions are nice for this one. So and it will rent 950. So this will also give you high yield. So
what yield would that give?
So let's say you buy it for 185, 950 by 12, 185, 6.1, 6.2 almost. Yeah, it's really good. So I'm just saying, like, that's why it's not the best part if Dresden, but it's still Dresden, so it's nice. But these properties, like for mortgage, doesn't really work. For example, this one is 220, 210. I think you will need to go for 220 because really nice house, more modern, and I think it's built 30 years ago or so. So it's not the best part in Manchester, but still good. So this is the M9, but it's really close to the. So like high individual who work here in the academies, or they will want to rent it because it's really close. So yeah, for example, this one is a nice house.
Yeah. So
also this will rent 1,100 by 12. So 220 everything. So 6% of yield. So and this
still good.
Yeah, it's good for this price. So it's not the best location, but it's still good. So yeah.
So overall, just to kind of generally wrap up in this, are you able to?
Yeah.
Yeah, there you go. Okay, are you able to twist your camera around or put the shutter down? We can't see you. The sunlight is blinding everyone. There you go, perfect. All right, so from a mortgage point of view, the market's dead. There's no really viable product around. Octopus, from what I can see, again, it's not financial advice, it's just my opinion. If it was me, I would be interested in Octopus. Your screen's gone dead for some reason, or your camera's gone dead.
Yeah, because I need to. Sorry.
Oh, very good. You're back.
Yeah.
And all right. So long story short, I think there are very few viable financing options at the moment, and interest rates are way too high to make it viable for a high LTV mortgage, assuming 6%. And I'm just all I can suggest right now is that if you're searching for property, there's good value to be had with cash at the bottom end, and the bet is that the market will just settle down, and then you'll be able to refinance at a decent rate and then get some cash return. Ultimately, property is a long play game, and prices will most probably go up because of the depth of demand in the market, which is unlikely to change in any big way over the next 15 years. So the key is, just as ever, it's all about good property, obviously. And the good thing is you can find really good property. There are a lot of people who really want to sell good property. And as a foreign national, you can get ahead of the queue because I think sellers are seeing foreign nationals as wealthier and therefore safer to sell to. So that's good. So that's my comment. What are your thoughts, Martin, to wrap up?
Yeah, I think there is still good properties on the market, as you said. Depends. If you want to go with mortgage, my point is buy cheaper property with 60% loan to value or so.
Yeah.
So you have a chance to buy the mortgage with around 7% of yield, which will still cover the mortgage. So, and if you want to go for cash, I think there is a little bit less competition, but the market is still hot. We still see a lot of higher offer. So if a property is a good, there is still people fighting for it. So
exactly. Although I see less competition at the lower end, the mid market is quite competitive, weirdly, but that's because there's a lot more money around there. But the bottom end, these little houses for £100,000, these kind of places, these are doing okay. You can get these for relatively easily. But the other thing just to say is that the banks, like Hampshire Trust Bank, minimum mortgage size 100,000, and unless they change that and go down a size or down a level, then it's just going to be difficult to find viable properties to purchase at the kind of interest rates that I expect they're going to charge. And it's exactly the same with Gatehouse. Gatehouse started offering £75,000 minimum mortgage sizes, and then they got flooded with applicants. And I just suspect that the way this is going to go is, say, either the interest rates are going to be very high or they're going to raise their minimum mortgage size back up to 100. But in any event, the numbers don't really work right now on mortgage finance. The only model that seems to work, in my view, is buy for cash, buy a couple of properties, then refinance with Hampshire Trust or something. That's what I would do. I would refinance with Hampshire Trust, for example, and get a 70% LTV mortgage so that I had enough cash flow. So it's geared down a little bit so that if there's another interest rate shock or something like that, I can sustain it. And then I would just make it a long waiting game. And eventually, as time passes, rents will keep creeping up and the thing will start to be more and more cash flow positive because that's how it typically goes. Rents go in line with inflation. So that's my take on it. All right, very good. There it is. Not much more to say. Thank you.
Thank you.